Good morning. Welcome to Bob's Coffee Chat. And today's edition is mortgages for self-employed borrowers you never knew existed. And to give our presentation today, we have Robin Kozelka, wholesale executive for Arc Homes LLC. Robin is an expert at helping mortgage brokers and mortgage loan officers like myself help qualify our buyers that may not fit the traditional Fannie Mae Freddie Mac model for loan approval. Specifically, Robin helps me help self-employed borrowers, investors, any people who may have a lot of assets but not traditional employment. Her favorite part of her role is meeting with loan officers and brokers on a daily basis to help us leverage available loan programs to get their borrowers qualified. Arc Home LLC is a leading provider of specialty mortgage solutions and offers full service nationwide residential lender and offers full service and is a nationwide residential lender and servicer. Arc Home Loans offers a complete array of loan products to satisfy the needs of the full spectrum of borrowers. So Robin, let's get this started. What are the mortgages for self-employed borrowers we never knew existed?
Hi. Hi there. Thanks for everyone for attending. And I hope that some of this is very relevant and will give you guys a lot of potential opportunities for yourself and others. But basically, I work for a lender. We are a wholesale lender. We work through people like Bob. And what we do is we help people that are differently qualified, really qualify for mortgages. I like to say, in a lot of cases, we help people not have to choose between the write-offs that they're entitled to and the qualifying for the home that they'd like to. So that is one of the big parts of what I do. Another big part of what we do is we help investors get properties and really be able to maximize the expanse of their portfolio. So they have the money for the down payment, they've got the credit score, and the property will even come close to cash flowing. We can get them a loan, and they can really build that portfolio faster than imaginable. If it's okay, I can share my screen with you and show you some, kind of take them one by one. Does that sound good?
Sounds like a plan.
Okay, so I'm going to share real quick. Screen sharing has failed to start. Hold on one second. Let's try it again. Sure. Okay, not sure why. Hold on, I've got a couple desktops. Maybe I'll take this out of full screen mode and drag it over, and maybe that'll help. So it's not allowing me to share the Zoom meeting. Or maybe we just don't need a PowerPoint, that's all. Hold on. Let's try to share this screen and see if that works. Can you see it now? That looks like promising.
You got it.
Can you see it? Okay, I'll make it big here. Now can you see it? No?
Absolutely.
Okay, and then I'm going to do this. So, wrong one. So basically, here we go. So non-QM is really short for non-qualified mortgage. So this would be not a Freddie or Fannie loan. And they're not really, a lot of people think of non-QM as the old school subprime, and sometimes it can be someone that might have had to have a bankruptcy or a foreclosure in the past. But really, I would say 95, if not almost all of the loans I'm doing nowadays aren't really those types of loans, although, we can if they're available. Most of the things that we do, like I mentioned, are for self-employed borrowers, investors, and people that might have a lot of money, but not maybe showing a job. So the first most common type of non-QM loans is a bank statement program, and are really done for self-employed people that might have a lot of write-offs. So if you've got a business where you might have a lot of deposits, what we would do is we would look at your business or personal bank account, and we don't look at what you spend really so much, as we look at what is the gross deposits for that business. So if you had a business that had gross deposits of $500,000 a year, for example, then we would probably be able to give you, anywhere from, 30 to 80% of that money from that. So we have a little bit of a formula that we use. And we would calculate how much of a percentage you'd get. And in our case, we've got a pretty aggressive calculation. So if you've got a service-based business and you don't have any employees, we're going to not assume that you have a very high expense factor. So I don't know what happened there. Can you see that? Sorry. It's all right. Didn't turn everything off. My Apple Watch. But nonetheless, so we would be able to give them like 80% of the deposits in the bank account. So that's one way that we can get around the fact that they can take as many deductions as they want. We're not really scrutinizing every spend. We're just looking at what's the gross deposits and what's 80% of that would be their income. So that could be really good. So for every $100,000 in deposits annually, you get about $80,000 worth of income. And that may be great because, in your taxes, you may be writing off 60%. So that'll actually help you qualify for a much bigger loan. The other great thing about our bank statement program is we do allow bank statements for people who are their primary source of income comes from, residential real estate. So if you're a property owner and you have a lot of residential properties, a lot of lenders, even though they might also do bank statement programs, they may not allow you to use bank statements to show your income. And we allow that. So that's really good. A lot of the non-QM programs, including the bank statement programs, do allow you to go to a 50% ratio front and back. And that's super important in the Bay Area because, when you're buying, maybe if you're buying a $200,000 house somewhere, smarter to keep it at a 43% ratio because things still cost what they do. But when you're in the Bay Area and you're moving into a $1.5 million to $2 million house, your residual income is going to buy a lot of Cheerios. So, we have the ability in this area to use a larger, and we have to, in a lot of cases, a larger percentage of our income on our housing. So that really does extend the buying potential for those. The other thing we can do that's priced exactly on the bank statements, you can either provide 12 months or 24 months, but we can also allow a lot of people, they might have multiple businesses. So they don't have just one thing going on. They've got a lot of gigs. So if you had multiple businesses, we also would allow those people to be able to do multiple business bank statements. So you can give me 12 months or 24 months for each business, and I can add that all together. And again, go to the 50 front and back ratio, even go to 90% financing on this. So there's a lot of flexibility here to be able to do that. Do you want me to admit Craig Adams? Hold on. There we go.
Oh.
So that's our 12 or 24 months bank statement program. It's very powerful, helps a lot of people. We do a ton of it. More and more people are self-employed now. And they've got, with the gig economy, they could be, all kinds of things. I had my TV installed the other day. Well, it was a while back, but when I had one of my flat screens installed, I had a couple of them installed, and an architect did it. So a lot of people are choosing not to be employed by someone. This architect made more money being a TaskRabbit and installing televisions all day. And let me tell you, he was pretty efficient and it was level. So it was great. So that industry growing is giving a lot of opportunities for these types of borrowers to be potential to borrow potentially. We also do allow, I'm just submitting these people, Bob, as they come in.
Sorry,
we also do have programs for 1099 employees. So if you're a consultant or a traveling nurse, and there's truck drivers out there, a lot of people are 1099 these days. So instead of providing the bank statements, they can also provide 1 or 2 years 1099s and a borrower prepared, non-audited P&L, and we can give them up to 95% of the deposits. And also in the bank statements, if you did want to provide a CPA letter, your expense factor is, lower than normal for that type of business, we can give, whatever the expense factor is, pretty much that the CPA claims that it is. So that does give a lot of flexibility. The other thing that anybody have any questions about how bank statements work and how we can use those?
Feel free to unmute yourself if you want to ask Robin a question during the presentation. Anytime.
So feel free to interrupt me if you're still doing that, but I'll move on. The other thing that we can do in non-QM is we can do full doc, 1 year full doc. So if you've got a business, and this could be a self-employed or a W-2 person, if you do have a year that was kind of slow, and maybe that year was slow because of COVID or something else, you can possibly do a 1 year bank statement program. So instead of providing the 2 years, you provide one. It's calculated very similarly. Otherwise, the next product that we have is an access, an agency plus product. And this product basically is a full doc product, but maybe you want a interest only product. So all of these products are available interest only. We have a 30 and a 40-year interest only. And the agency plus gives you ability to get interest only payments with a full doc income. So that's not necessary. And that could be self-employed or W-2'd. So that's really nice. The beautiful part about that is you can pay interest only. A lot of times the most of the money you're making on your property is from the appreciation of the property. So this gives people the ability to go out and buy, for the same payment, a more expensive house. And they find that they make more money just having that asset be more valuable. And especially with the appreciation that, we've been having, they get more money in the appreciation than the money that they would have gotten by putting that extra principal down. So they're happy to do it, and it's an option for them. So the interest only products are available on all of our products that you see here. And except for the debt covered, the DSCR, we can do a 30-year only on the debt service coverage ratio, but we could do a 30 or a 40-year IO on the on all the rest of the products. So that's really cool. Asset utilization. This is a product that I don't know if you're, I'll get that one. The asset utilization or ratio product is a great product. So in the Bay Area, we have a lot of people that might have had stock options. They might have had, money from an inheritance. They might be a trust fund, trust funder. They may be someone that has made a lot of money in cryptocurrencies, for example. Although we don't use cryptocurrencies for the loan, if they take that money and put it into regular bank account or a regular investment account for 4 months, we can actually get them a loan using that, and then only that. I have a friend that put every penny that he had, and since it was, and I'm kicking myself because he told me to buy in at 100 to Bitcoin, and he put everything he could into Bitcoin, and now he's sitting pretty, but he doesn't have to work. He doesn't have a job, and the money is in cryptocurrency. So how would he qualify? What I would do is I would say, hey, put it in another investment vehicle for a little bit, or in a bank account right now, if we think that things are going down, let it sit there for 4 months. And then we can use that. The way we calculate the income from that is we would divide that income. Let's say it's sitting in a checking, savings, or money market account. We would take 100% of that money, and we do it by 36 months. So what does that mean? That means every $100,000 that you have would equate to approximately $2,777 worth of income. $500,000 would be 3,000 or 13,888, so just under 14,000, and $1 million would be around 26,000 a month of income that we count as his or her income to go to qualify. So I've had people that have a lot of money. You'd think, well, why would they want to use a product like this when they can just buy the house in cash? Well, a lot of these people are qualified investors, and they might be getting 10, 12% or higher on their money. So they're happy to pay the little bit of premium that it would cost for them to do this. I did a loan for a guy that, he sold it, he cashed out of the company. He'd been traveling around in a $500,000 RV. So he bought an RV in cash, didn't have a rental history. He didn't have a job. All he had is some money sitting around, and we were able to get him a loan. And the financial planner was really happy about that, because he didn't want to lose $5.5 million of asset under management. He would he wanted to keep on investing that for his client. So did the client. So it really worked out well for the financial planner. It worked out well for the borrower. And it worked out well for my loan officer, who, was happy to be able to do that loan. So we got
Robin, I want to make an important point here, because I've used your asset utilization program too. And just to give you a comparison on Freddie Mac, to use asset utilization, number one, you have to be of retirement age, and you have to use it from a 401k or an IRA. And number two, you have to according to Freddie Mac's calculation, amortize what you can theoretically earn off of that money in the account over 30 years. In your case, you don't have to be retired, right? And how many years do you amortize?
3 years.
3 years. It's amazing. It's like if you have $1 million in the bank, how much would that be roughly for income, would you say, Robin?
That's what I'm saying. At $1 million, if it was a checking, savings, or money market, it would get you over $26,000 a month.
Isn't that amazing? I mean, you don't have to do anything with the money, but just have it sit there in the bank, and you can qualify for a loan at $26,000 a month income.
And the documentation type is very, very easy. You basically just provide 4-month statements of that account, and that's it. You say, hey, here's the account, and there it is. You can use this for purchases, refinances, even cash out refinances you can do on this. And this is not just for people that are just swimming in the money. This also can be used to supplement either full doc or bank statement income, or it could be used to supplement even Social Security income. I recently did a loan for an 82-year-old widow who was in her home and wanted to stay there in the Bay Area. That could be a lot. She wanted to do a refinance. I got her $750,000 loan amount, $750,000 on Social Security. She had $400,000 in her retirement account. Because it was sitting in a retirement account and she was retirement age, we used 70% of that. And we took 400,000 times 0.7. The number that we got there, we divided by 36. I think that gave her about $770 a month in income. We added that to her Social Security income that we grossed up, and we were able to, on this product, if your primary source of income is asset depletion, we do use a 40% ratio front and back, but it was enough to make her qualify. So it was a really good deal. And she didn't want to do a reverse mortgage. This is what she wanted to do, and she had the power to do that. What does that mean? That means people that are sitting there and they feel like, I have to do a reverse mortgage. I'd like to live in something smaller, but this is what I have, and I'll no longer qualify to downsize and get a condo or whatever. And maybe they need that. So this can help not just people that are, have done very, very well for themselves and have a ton of money. This could also be, a retired widowed woman. So it's, it was a great product, and I'm happy to use it.
And I'm very happy. I'm very happy to use it too, because I like the way you do the patchwork thing. It's like you use Social Security here, asset depletion here, you patch it all together for one big product that makes it all work for everybody. So it's just wonderful to have that available. Somebody had a question?
Yes, Robin, I have a quick question. Trust assets, those would qualify as well for this program?
It depends on the trust, and you'd have to send it to us. In some cases, it is an exception to do that, but I've done it for sure. And yeah, a lot of times that money will be in a trust so that we can. So it depends on the type of the trust. It should be a revocable trust, and there's some guidelines around that. But if you have a question about it, definitely call. And move these pictures over, because every time I look at people, it looks like I'm looking in the wrong place. Yeah, so it's a possibility, and we've definitely done that before. I actually had a call from someone that was, the realtor was freaking out. They were in contract. It had fallen out at another lender. The guy was just so arrogant about how much money he made, because he was like, well, I'm a financial planner. He had 12 different retirement accounts. He had tons of money. He had 3 different businesses. He had 5 houses he was paying for. One was, he had a condo hotels, and he had a house he paid for his parents. And then he had his primary residence, so he was moving out of, but he wasn't selling, and he wasn't going to be renting it. So he had to cover that mortgage. Plus he had to cover the new mortgage. And all of these are multi-million-dollar mortgages. And it turns out he didn't qualify. And it got brought to me. There was only, 2 weeks into the end of the escrow. We obviously got that extended. But what I was able to do, we couldn't use his primary income. Oh, end of the story. The real problem was he had been a financial planner for one big firm, whatever, I don't know what it was, but let's say it was like Morgan Stanley or something like that. And he moved all of his clients over, and he took them private. And so he made more money doing it that way. And obviously he wouldn't have made that move if he wasn't. But he doesn't have he's self-employed now, and you need a 2-year history of being self-employed at most lenders to get a mortgage. And so that income could not be included. So had I not been able to do bank statements, and had I not been able to use bank statements from multiple businesses, which most lenders wouldn't, and had I not been able to give 80% without a CPA letter, which most lenders won't, and had I not been able to go to 50 DTI front and back, which a lot of lenders won't, and had I not been able to supplement it with a supplemental asset depletion from like 12 different, retirement accounts. So we had to pull all that secondary and tertiary, employment income along with that asset depletion income, and combined it all together, and we were right there. I think we even need to have an LTV, a DTI exception, but we got the deal done for this borrower, and we knew that he made other money, so that kind of helped us get that exception. So we were able to say, hey, look, there's money we know he makes. We can't technically count it, but we know that it's of value.
Robin, that was my client. It was my first.
Was that your client, Bob? I'm sorry to call your client arrogant.
That's okay. No, that's
fine.
It's the very first loan I sent you.
But I didn't want to say.
Oh no, I was really happy.
Do you remember that story, Bob?
God, it was like I had nightmares at night trying to make that all work, and you made it happen.
But we sat down, we got a spreadsheet. Bob and I manually did that. We didn't just send it to the underwriter. We're like, we're going to calculate it ourselves. We're going to get it done. Bob really did roll up his sleeves on that one. I thought that was you, and I didn't want to say. They all kind of blend together after a while, Bob, because I do this every day with a lot of people, and I thought that was you.
Well, that was my first one with you, and it's like I was sold ever since. It's like, we can get this loan done. We can get anything done.
But you know what? Would any other lender have done that, Bob?
I don't think so. No.
I don't think so. And even at my lender, I don't think other reps would have done that. Not to brag, but there could have been, but it was hard. And it was, and I had a really good underwriter on that one, and he was very patient with us. And I just even made my own Excel spreadsheet. I'm like, here's how I see this working. And we packaged it together. Bob was cute. I'll have to say, Bob, he knows better now, but Bob was, I'll remember this about you, Bob. When you first brought me the deal, you just shipped me like 45 documents or maybe more. You just gave me the zip file, and it had like, and these were like, oh, maybe even more. It was hundreds of documents. And it was like Bob was like a child going up to buy a candy bar and said, hey, I want to buy this. Here's the bag of money, and dropped it on like, I don't know how to count, just do it for me. I'm like, Bob, not going to be how it works. We're going to do this. I'll help you. I'll be there, but you're going to do it.
What made it a little difficult was you have different calculation formulas, but it's to our advantage, just like the asset depletion using 3 years instead of 30 years. I mean, stuff like that made it happen. And it's just like I had to rethink the way how it works working with you to make it happen. And that's how we can make up these creative solutions where other people can't.
He will never send me a zip file with 45 different documents.
Listen, I've got all those Excel spreadsheets.
Go through this for me. I'm like, no.
I got all the Excel spreadsheets set up going, here's 4 months average on bank statements. Here's my asset depletion. I got it all set up now.
A good job. We got it done. And I think I've done a lot more since then. So I do, but it took a little pushing internally because it wasn't very, that's what happens. Like we have the flexibility to do that. And if you're working with some strong, a participatory, loan officer and a good underwriter that was open to doing this, and my team is very supportive. So we were able to go to the team and say, hey, here's where we think this is going to make sense. Here are our compensating factors. Here's what, where he's really getting all this money that we can't count. And, can we make this deal happen? And we were able to get that. This climate is a little bit more strict than that was. I don't know if I would have gotten that done today in the middle of, World War III, but, we're still making exceptions every day. So if something is not perfect and you think that it has merit and there's, someone wants to do something, you don't need to know how to do it. You just need to know, call Bob. Bob will call me. He'll tell me what you're trying to do, and we'll find a way to make it work. And that's the fun part of what I do. So anyway, so there's that. And the final thing I'll talk about today is clean slate. Clean slate is for people who have had major credit events. So this could be a foreclosure, it could be a bankruptcy, and we can do it with as little as 12 months seasoning on that. Prior to COVID, we were doing this with 1-day seasoning. So 1 day out of a foreclosure or 1 day out of a bankruptcy, we were able to get a loan done. Now it's a little bit more strict. We do wait 12 months, but we can get that done. If people have had, and I don't know if you know this, but even if they've had a foreclosure, a forbearance recently because of COVID, those are not a problem. We don't have to wait that 12 months. So if it's a forbearance due to COVID, as long as they've made 3 months payments on their payment plan, or they've started paying again and they're current, we can do a loan immediately. So those are basically the non-QM products. Oh, I didn't tell you, we skipped over one of the most popular one. It's called debt service coverage ratio. And has everyone who here has heard of debt service coverage ratio? Anybody?
I have. It's the big new thing now on non-QM. All our wholesale reps are selling it.
Yeah. So the exciting thing about debt service coverage ratio, the really crazy thing is a lot of realtors don't know about it. And if realtors don't know about it, a lot of people, they don't go to a mortgage broker first. They don't know they don't even know what a mortgage broker is, frankly. Sorry, Bob, but they don't know. And so they know about a bank, and they might go to a bank, and the bank is never going to tell them about this product because banks don't have these products. Only, you only get these going through a person like Bob that has access to lenders like ours. But a debt service coverage ratio it stands for, or DSCR stands for debt service coverage ratio. It's sort of like what commercial lenders do when they qualify a big building, right? If you're buying a 100-unit building, the person doesn't have enough money to cover the whole mortgage. They're using the rental income from that property as income to qualify them. This is the same thing for 1 to 4 unit residential properties. So these have to be done for investment properties. You're going to use the rental income as qualification. You need no income from the borrower. And let me repeat that. You need no income from the borrower. So the borrower could be unemployed. They could be retired. It doesn't matter. We don't have to show, we don't have to tell what they do. They don't have to make any personal income. So what we would do, let's say we were doing a purchase, as long as the rental income from the property, and that's either the actual income or the market rent, whichever's lower, if the rental income from that property is going to cover at least 75% of the 75% of the
gross rent.
The payment basically of what it would cost you to have it. So it could be the principal, interest, tax, and insurance if they're doing a P&I loan, or it could be the interest only payment, tax, insurance, and HOA if they're doing a interest only loan. As long as the rental income will cover at least 75% of that expense, you're qualified. And it's an amazing product. So let's say you've got a person, hey, I've got a lot of money saved, but I maxed out my DTI when I bought this house. And now, because houses here are $2 million or whatever. But hey, I've got the money and I'd like to start my investment portfolio and I want to grow something for my family and for generations. You can do that if you have the credit score and the down payment and the property cash flows or comes with close to cash flowing. So what are the limits? If you're trying to do a 0.75 DSCR, which means it's going negative 25%, we can lend up to 75%. You'd have to have 25% down. And we could do that up to $1 million. If you wanted to go over $1 million, or if you wanted to go up to 80%, you would have a debt service coverage ratio of 1 to 1. So that means if the rent is $4,000, and the PITI was PITIA which is principal, interest, tax, and insurance, and HOAs. The expense of the property was $4,000 and the rent was $4,000. You qualify. Here's the other thing I'm not looking at. So I'm not looking at any personal income. I'm not looking at any personal employment. What I'm looking at is and I'm not looking at any other debt. So I don't care if you've got multiple car loans, if you've co-signed for your children's college tuition, it doesn't matter. I don't care how much credit card debt they have. I'm literally looking at, is the investment, is the renter going to cover the expenses. That's what it's looking at. So it's, as you can imagine, it's a really flexible product. Other things people like about this product is that you can, you don't have to have landlord experience, which a lot of other loan programs do require you to have. We allow you to do up to 20 properties, not 20 properties with us. You can be quite a few of them with us, but many of the programs traditional banks will offer you, you can't even do over like 9 properties. So we would expand the number of properties that you can purchase. And you can also hold the title in an LLC. So this is a really, really exciting product. Loans could go up to 2.5 million. If it doesn't quite ratio, even with the interest only payment, you just have to put a little bit more money down. So it's a really powerful tool. And I'm really surprised that real estate agents aren't pushing this every day, because what they're doing is, as soon as they've got this great investor and the investor's like, buy me as much as you can, as long as it comes close to cash flowing, I'm happy. Just find me some properties and I'll buy them. And then they get 9 properties and they're like, that's it, we're done. Or they've got a borrower that would be open to buying these properties and they can't, or they themselves could buy these properties. They see that they'll cash flow. They know that they're good investments, but realtors' income maybe not that consistent and doesn't really qualify other ways. So these are really great products for people that are really trying to build, something for themselves and not maybe walk away from their 9 to 5. This is the one. So this is why I included this in self-employed borrowers.
What I really like about it too is you can qualify on the interest only payment. That's huge with interest rates going up the last couple of months.
Huge, huge, huge. So it does work. It's a little bit more difficult on a purchase with the rates going up like this, but with that interest only payment, it helps a lot. And, investors are used to putting 20, 30% down. So if it doesn't debt coverage, you can always put a little bit more money down and then it will. The other thing is that because we do the investments on this one, it doesn't mean that we can't do investments on bank statements. So if you don't like the rates on this, which is probably the highest of the rates, if you don't like the interest rates on these, you can also do bank statements. But people are still buying it at these rates. They're in the high 6s. They could even be in the low 7s, depending on what you're doing and what your FICO score is. But it's still a winning proposition with the values of the properties going up the way they are, and being able to get in, because we don't know what the interest rates are going to be next year. But what we do know is we know that property values, we don't even know that, but property values have been doing very well. And this is a great product for a lot of people.
And, we also have an investor that will do 5 to 8 unit properties as a residential mortgage, as opposed to a commercial one. So it's interesting how many different products and availabilities we have for it. And there was a question if we can get your slide deck, Robin. So I just want to let everybody know that I have a YouTube channel called Bob's Coffee Chat. If you can log on to YouTube and subscribe to my channel, after we're done today, I'm going to post the recording up there and it's available to everybody and anybody that would like to see it.
I thought I'd show you this as long as people are asking for the deck. This is the asset depletion, how they qualify. We do actually have some products I didn't even mention today. We do have products that this is an asset depletion for 4 months. We also have one if they can do it with the 24 months. They have enough money to do that, or not 24 months, I'm sorry, 120 months instead of the 36 months. Maybe they have a lot of money. We can give them even more aggressive pricing. This is just our traditional non-QM, but we also have products that if you have the 24, they allow you, if you run DU, which is that you don't need to know what that is, desktop underwriting. But as long as they qualify, otherwise their just problem is the loan amount is over the conforming limit. We can give non-QM loan amounts and non-QM doc types to a DU or desktop underwriting type loan, which will give you, even lower pricing, very, very close to conforming or to conventional type of lending. But you have the ability to do limited non-QM doc types. So you might not be able to do a 12-month bank statement, but you'd be able to do 24 months. You might not be able to do investment properties, but you could do the owner occupied or your second home. You might not be able to do a 36-month asset depletion, but we can do a 120-month asset depletion. So this is by far not the only types of loans we have. We do have amazing agency loans. We have amazing full doc non-owner investment loans that are pricing way better than market. So those are pretty good. And all of the, your traditional Fannie Freddie loans, normal types of investing, you can do that as well, all through us. And all through, you could go to Bob for those. Maybe he'll send it to us. Maybe he'll find someone even more aggressive on those than us, but those are also available with us as well. That's all I have. That's the stuff. Any other questions?
I think we're good for this portion of it, Robin. So I'm going to stop the recording, and Robin, make sure to put your information in the chat because we do have mortgage brokers here as well too. And I'm sure they'd love
Okay,
to
good.
send
I'm
you some
glad.
business as well.
Any questions? I'm looking here. Have we been reading the questions?
Yes, that's the first one I saw for your contact
Oh, there's
information.
someone offering bridge loans. We don't offer bridge loans, so those are, I wish we did. Those are really handy. This is my name. I'm putting my name and contact information, and thanks for having me. I appreciate it. Anyone have any questions before I go?
Well, if you can stick around, and this
I'll
will
stick
stop the
around.
record. This will be the stop the recording part of the session,
Okay,
and we
that's
can open up the Q&A.